Good afternoon, everyone. It's Joe Gordon, and today is Tuesday, September the 8th, the day after Labor Day, and it's our weekly update live session. Our disclosure page, as usual, in very small print. In essence, we're not giving any investment or tax advice or any advice for that matter, and basically just trying to bring you up-to-date current information to help with informed decisions by us and you if you're a client, and hopefully by us and you if you're not a client and would like to talk. So as always, you can follow us on various social media on YouTube. You can go Gordon Asset Management, just do a search, and all of our broadcasts will come up. You can sign up on wealthqb.com, and we have a Twitter and Facebook page as well. So always, we start off with a couple coronavirus slides, and you can see here just a quick update. Last week, total cases climbed a bit. From just under 6 million to over 6.2, pushing 6.3 million. Hospitalizations decreased week over week from 35,000 to 32. Deaths increased by about 6,000 from 175 to 181, and so forth. So again, the death rate and so forth is flatlining. The hospitalization rate is also fairly flatlining, but the cases tend to go up. There's more testing and so forth. So global confirmed cases, and this is just trend analysis. If you look at daily increase in cases, clearly there was a spike in Southeast Asia. There is a second spike in Europe. There was a spike in Latin America. It is seemingly now under control and decreasing. And then we have North America, this gray line. We've been in a steady decline since the spike back in May, early June, when a lot of the states opened up, especially in the Southeast, maybe a little prematurely, but at the end of the day, those are under control now. Increase in fatalities, you can see similar data. Europe spiked way high back in March and now is trending way low. Other than the fact there'll probably be some more trending up in fatalities based on their spiking in cases in the second outbreak. North America, we've had kind of a jagged line when we reopened, and that trend is downward. Southeast Asia fatalities are up, and Latin America kind of jigsawing there a little bit, doing its own thing. So how does that affect markets in the past week? You can see internationally, developed markets outside the U.S., Europe, Australia, Far East, the EFI index fell about 1%, now down 7%. Year to date, interestingly, they were up yesterday, Labor Day, when our markets were closed. EM markets down 0.62, so year to date down just under 2%. And the global aggregate bond index fell about 36 basis points last week. It's still up 5.75% year to date for internationally people that are invested. In any fixed income, they've made money this year, which is good. And the U.S. markets, trend reversal. This is the first time. We've been kind of calling it because we felt like the U.S. tech market was getting a little parabolic. That seems to be the operative word being used by a lot of experts, including David Rosenberg, economist. So you see here, the S&P fell just under 4.5% last week, and now is up only 3.62% year to date. NASDAQ got crushed, down almost 7% last week, which dropped its plus 33 down to plus 27.59. The Russell also took it, so it wasn't like a rotation, down 2.73 to put its year-to-date loss at just under 8%. And with rates falling and near zero bound, the Barclays Aggregate Bond Index up 15 basis points, year-to-date up 6.76. So you can see here on the graph, the orange being NASDAQ 100 level change. That's a pretty big move to the downside. We'll see if that persists. Then if you look at the gap between market cap weighted and equal weighted indexes to give you an idea of who is really pulling the indexes up or down, you can see the purple is the NASDAQ 100 market cap, again from a peak of 33 down now to up 27. Equal weighted on the NASDAQ 100, only up 13.5. So clearly still a lot of the heavy lifting done by the 5 or 6 mega cap stocks. S&P, similar story. with the mega cap stocks becoming about 25% of the S&P index on a market cap. It's down up still 3.53, but overall equal weighted S&P 500 down almost 6% year to date. So what's going on? So here's a couple data points. August was a historic month, and now we're entering September. We're 8 days in. Typically the worst month of the year on average in the stock market. So the gains were 7% in August. It's one of the best returns in August since 1984, or it is the best. And basically, the data says that when you've had big August gains, don't expect it for September and October, because it just doesn't happen. And so essentially, the S&P was up more than 5% in August of '86 and 2000. The market fell 8.5% and 5.4% the following month in September. Our point here is that it doesn't mean it's going to happen again, but don't be surprised if it does. Many times when you see parabolic moves and stock prices, it's just pulling gains from 1 month and forward to current. So it's just heavy demand on stocks. So let's look at other issues, broad market. So the broad market actually did better last week. So SPY, for the S&P 500 ETF, was only down 2%. However, Apple down over 6%, Microsoft 5%, Amazon 4.5%, Facebook down 3.57%, and Google down 2.64%. So clearly there was some bloodletting in the technology market, and it wasn't spared on the broad market, but significantly the big mega techs, mostly those three, Microsoft, Apple, and Amazon, took it in the shorts a lot more than the others. So let's look at worst performing sectors last week. Clearly you can see it's maybe a rotation starting. Tech down 4.39%, healthcare 2.36%, communications down 2.34%, consumer discretionary down just under 2%. And then a rotation, this is the value type sectors, materials up 2.3% and financials up 0.92%. So there's no evidence there is a growth to rotation to value yet. You would need to see that from week to week, and that's why we do these updates. But clearly that could be the sign of a new trend. And let's face it, materials, financials, energy are very, very cheap relative to the growth sectors. So when you look at S&P valuation measures, obviously the PE ratios come down a little bit as of September 4th, 22 times. And again, the megatechs are well over 30. The other stocks in the index are around 16 times. We're not that concerned about this particular data point, but it is what it is, and it rivals back in 2000, which we'll have a couple comments at the end of this. Inflation and gold. So basically, inflation's been benign despite a 20% expansion of the money supply, the Fed liquidity injection, which in essence has saved the stock market. Gold's up 27% in dollar terms year to date. That's down from 29. So last week you had a little bit of reversal where the dollar strengthened a little bit, and there was a gold sell-off. I think gold this morning's at $1,920 an ounce. It has been over $2,000 an ounce at its peak this year. Inflation, you can say more of the same. It's just not in the data, even with all the liquidity expansion. You can see it down here, the CPI and core CPI is just not there. And so we're going to keep an eye on it, but there's a lot of talk in the press from talking heads who really know nothing. We should call them nothing heads about inflation. Look out, inflation! The cat's out the bag. Inflation. Don't see it in the data. Some of our favorite experts in this area, Lacey Hunt, chief investment officer at Hoisington in Austin, Texas, doesn't either, and he's been right spot on since 2006. U.S. employment, you can see here continuing claims, 13.25, down from 14.5 million the prior week. That's good news. Initial claims held steady at 1 million. The unemployment rate fell to 8.4, down from 10.2. That's the headline number, and the trend is looking good. But you really most of the people on CNBC and others and Fox Business, all they talk about is the headline number. They don't ever really peel the onion to see what's really going on. One of the biggest creators of job last week was in government, which was part-time job for people to do the census. So I think you really need to look at it. And here's basically the government. 344,000 jobs created last week. The good thing was leisure and hospitality coming back 174,000, professional and business services just under 200,000, and even retail popping up a good bit. But as far as manufacturing, construction, and et cetera, you're seeing growth, but not a whole lot. So that's why we need to keep our eye on that one. Small business optimism, it's average, it's down, but it's not out. But basically, small business was approximately half of the GDP, create more jobs than medium and larger businesses. But the optimism's not good, and there's a reason. Many of these small businesses are still closed. Ask any restaurateur in New York City whether they own a restaurant or a bar. They're not open. Ask them if they own a salon. They're not open. Some states are open. Some not. Clearly, the issue in California with the salon owner that Pelosi snuck in, and everyone's closed in the state. Well, I learned over the weekend that public gyms are open, but private gyms are not. You can't figure that out in California, but it is what it is. So optimism clearly is not going to be peaking until people get a chance to reopen. High frequency economic activity, still a huge expansion in purchase mortgage applications, people fleeing the downtown areas, wanting space and distancing, and the suburbs, work at home. You don't need to be in a big city. I think San Francisco is suffering the biggest loss of people migrating out. New York City, close second. But it's even happening in North Carolina, people leaving downtown Raleigh and going out into what you might call the suburbs of surrounding areas, Apex, Holly Springs. Fuquay Varina is really exploding. So, but when you really look at this data, you still see credit applications are still down 8%, use of credit and debit cards, but it is, flatlining right here. But hotel occupancy still down 28%. That's this olive-colored line. Travel, navigation app usage still down 40%. That is this particular line here. U.S. seated diners still down 33%. Again, as I just said, many states you cannot eat inside, such as New York, which is killing that industry. And then TSA, travel, traffic still down 71%. That's this Carolina light blue line. Interestingly, I think it was Friday of Labor Day weekend, there were the highest number of daily travelers, according to TSA, since the pandemic started in mid-March, over 900,000. But that's still down from 2.4 million. So, it's still way down. So the high price of recovery, federal debt now exceeds 100% of GDP, and this has historically ominous implications for growth and going forward. Debt is future consumption denied, Adam Smith famously said. So with this in mind, we could see Japan-like stagnation and growth going forward and zero-bound interest rates. I mean, their market peaked in 1989 and still not gotten back almost 40 years, or over 40 years, or 30 years later. But anyway, so it hadn't happened since World War II. That's why we have to keep an eye on it, and it's not generally good news for future growth. So what are we watching? At the end of the day, not a whole lot happened last week except the bloodletting in NASDAQ. But there are some issues. COVID developments. You've got the vaccine talk. 9 companies today said ethically they would all work together and do the right thing for the betterment of the global population and the U.S. population, non-public companies. We have second waves going on. I saw where the Midwest now has a spike, and then you have literally virtually schools going all online with few exceptions. So that seems to be the trend, and a lot of people are struggling. 2-income families with young children, that was a really tough situation. Daycare centers not opening. So it's really a massive challenge. So we'll see what happens with the disruption to public education. You also have the election and all this hoopla about the postal service and ballots getting lost and voter fraud and mail-in voting. So obviously that's a big issue. Then you got new stimulus efforts and the impasse with the House and Treasury. White House spokesman today, Mark Meadows, said, he former congressman in North Carolina, that they thought they were fairly close, but there was published as $1 trillion shortfall, and the White House, led by Treasury Steven Mnuchin, they don't really want to bail out cities and states that fiscally ran very bad financial enterprises. So we'll see. Inflation, money supply expansion. Inflation's really benign, but we're watching it. If it does tick up, it will have a huge impact on the price of commodities and miners related to those commodities, gold being top of mind. And then also September. It's the worst month for stocks historically, especially after a record August, which we had a record August, the best since 1984, according to LPL, 86 according to other data I saw. But anyway, the best. And then the market breadth issue versus the 5 megatechs ruling today. We'll continue to watch that development as it'd probably be very healthy that the megatechs sell off a little bit. And I'll give you some anecdotal data on that in a second. And then dollar weakness against the euro and others is good for EM equities. Really? We'll see. It kind of reversed itself a little last week, which is why EM equities likely were down. And then the last issue, growth and value and sector rotation. Is it really happening? It doesn't have to. But at the end of the day, in today's business by David Rosenberg, he talks about how do you define a bubble. And there's basically 5 ways. It's very simple: price, valuation, leverage, sentiment, and new era thinking. And so basically, when you think about price, we're at a 2.5 standard deviation between the S&P 500 and its 200-day trend line, and so things are out of whack. And then also, you look at valuation. We looked at it earlier, but the trailing PE multiple is really 30 times from 18 times in March. That's a huge expansion. And if you look at October '07, the CAPE, or cyclically adjusted price earnings ratio, is at 27 times. We're right there right now, and at even up to 30 times actually. And then generally these are in the top 0.5% of valuations all time. And then you got leverage. Leverage is going on. It's notably in the tune of margin debt. Margin debt is up 110% at an annual rate year over year. And exactly this is what happened in March 2000 and July 2007. No one saw trouble brewing. And then a couple last comments on sentiment. The sentiment index, wildly bullish. Citigroup has this panic euphoric index. It's at a record high, 2 standard deviations above the norm. And then basically, Investors Intelligence poll shows 64% bulls, 16% bears, a gap in the past that always presaged a market pullback. Lastly, the issue of new era thinking, which I find comical, is, as Rosenberg mentions, I wonder how many Tesla investors actually own a Tesla product, but it did surpass Toyota in market cap, even though they only sold 368,000 units in the past year, and Toyota sold 10 million. And so when you really look at that, and that their market cap's expanded 5-fold since March and is now over 400 billion, it just seems a little out of whack. And then you got Zoom. I mean, Zoom has become a verb. 663 million in sales in the past year, yet its market cap exceeds IBM. IBM had 18 billion in sales. And then Apple. When you look at Apple, you have to say, okay, great company, great products, but why is it getting such a valuation premium? And so essentially the market cap has soared 27% at an annual rate the past 5 years, and yet the profits and revenues have only gone up 4% a year. Usually when that happens, at some point, it stops. At the end of the day, Rosenberg concluded, well, Tesla makes no money, Apple has no growth, and Amazon makes no money in its delivery business. Yet these are all stocks everyone says you must own. It's a new era. So we'll close the day by saying we hope it in a new era for those that are long in those sectors. We've been patient with our clients, and Had fear of missing out a little bit because when you see things go, but now that we know what the data says, it's going to extremes. And essentially, all of these things do wash themselves out. So we'll see as September rolls on, and we're less than 60 days to an election that everyone says is the election of our lifetimes. So we'll see. Well, that's it for today. That's a wrap. Thanks for attending, and have a great week.